Hi, it's Barry Page. This video will be about financing and solving for the need for finance using participating life insurance. When speaking about financing, most people think of financing a car, possibly a mortgage, or purchasing furniture for their home. But if you've studied the infinite banking concept created by R. Nelson Nash, you understand that we finance everything that we buy. We either pay interest to someone else for the use of their money, or we give up the ability to earn interest that we would have earned otherwise by paying cash. If you've ever been to a traditional bank in search of a personal loan, you'll understand that it's a lengthy application process. Now, the same can be said about life insurance. There is an application process that goes through underwriting where they will look at the health and the financial requirements deemed necessary for that particular product. Let's talk about where we store our money. Most people store their capital at the local bank. But what we're talking about here is becoming your own banker. We like to call this safe money, money that we can get our hands on. It's liquid. Maybe it's just rainy day money in case we need it for an emergency. It's usually stored in checking accounts, saving accounts, maybe a money market, or even a CD, certificate of deposit. But who benefits from your money that's stored at the bank? Let's face it, banks make money by loaning out other people's money. And even if you have a savings account or money market, chances are you're getting less than 3%. 1 to 3% are typically the rates today. So an IBC infinite banking concept policy offers many unique advantages that you don't get from a traditional bank account. Things like guaranteed predictable growth over the entire life of the policy, not something that's going to fluctuate with the Fed rate. How about tax-free growth and tax-free distribution if set up correctly? Now, this is under current tax law. However, these laws have been in effect for well over a century. It even has a natural hedge against inflation because it's guaranteed to grow every year. We have to remember that our wealth must reside somewhere. And what better place than an entity that we own and control? So let's demonstrate our need for finance. We're going to take a look at the numbers and a few graphics just to help you grasp this concept. So we'll be working direct from the book, Becoming Your Own Banker by Nelson Nash. On page 3 of the book, Introduction to the 5th edition, which is actually the first page of reading, this book demonstrates that your need for finance during your lifetime is much greater than your need for protection. Solve for the need through this instrument and you'll end up with more life insurance than the companies will issue on you. And I've dealt with this firsthand over my years in the business. Many times when we try to solve for the need for finance, it throws the underwriters off because they think differently. They're thinking about death benefit. So this is a great example of using your need for finance versus your need for protection. Jumping ahead in the book to page 21, creating your own banking system through dividend-paying life insurance. The very first principle that must be understood is that you finance everything that you buy. You either pay interest to someone else or you give up interest you could have earned otherwise. Now this is a head scratcher. Many people have to really think about this to process it. Let's look at some numbers. Okay, so to illustrate the concept, you finance everything you buy, we're going to take a look at the Circle of Wealth Money Tracks calculators. Now, of course, the primary purpose of life insurance is the death benefit. So if you look at it like an underwriter, your economic value, age 40 to age 65, 25 years, you never got a raise. That would be your human life value, economic value of $2.5 million. That would be the way an underwriter would normally look at things. And in the book, the purchase of a vehicle is for $10,500 and some change. However, this book, as you probably know, was written years ago. So we're going to update that a little bit, and we're going to say the vehicle costs $30,000. And we're going to look at that over time, financing the vehicle at 5%. We're just using some round numbers here. Obviously, rates might be a little higher now. They could be lower at times, but we're going to use 5%. We're also going to look at 60 months or 5 years, and we're not going to pay any extra in this example, but there is an opportunity rate. That is the cost of money. So if your money were earning, in other words, if you were giving up the ability to earn interest and your money was earning 5%, so you have $30,000 saved. Now, initially, you're going to have to save money. 5% earned, 5% paying. If you look at the results in 60 months of the payments being $566.14, you could either pay cash, which would mean you take your $30,000 here and you drain the tank. So now it would no longer be earning 5% interest because you've taken the money out of the account. On the other hand, if you have a liability, you're paying down that liability with that 5% interest rate. We'll just let that go on through. As you see, the balance is going down, the savings is going up. So at the end of that time, both accounts would be equal, if they were full, to $38,501. Now, all of this is not interest. The interest paid right here in this number, $3,968, but you lost interest as well had your money been earning interest. So the total cost of ownership in both scenarios is $38,501. So you just have to compare which is best. Would you rather have a liability, or would you rather use your collateral to make a purchase? In either example, you wind up with the same number, but ask yourself which offers the most control. You could, of course, make an extra payment in this example here, $200, and that would pay off the loan quicker. So your total cost would be less. Now, you still have interest that is lost, you just would have paid more. So you might say, well, what about the higher yield? Let's say you're earning more, or you got a lower rate on the financing. You might have higher gains, you might have higher control. What if the opportunity, the money that you're earning is less? So you have lower gains on your savings, you still have a higher level of control. What we're talking about here is financing through your own system. And I know some people don't like paying interest, other people like earning interest. But you have to drain the tank. You have to take money out of the account that's earning interest if you're going to pay cash. So you finance everything that you buy. When you do drain that tank to make the purchase, you've lost control of the account. The account is no longer earning interest in the same capacity. Of course, it takes time to fill the tank. So you're going to want to have a plan for saving money on a consistent basis. So here are a few things to consider. Assuming you're in the same rate of interest you would have to pay if you borrowed, the cost will be the same. Paying cash drains the tank and resets the compounding of your money. If you earn more interest than it costs to borrow, keep your money and borrow from the lender. Maintaining control of your money may be worth paying higher interest. Borrowed funds require a reduction in future lifestyle to replenish or refill your tank. Paying cash is financing. It is self-financing. All right, we're going to look at this one more way, financing a car and the true cost of finance, because again, you finance everything that you buy. So if this were your circle of all of your money and you're going to purchase a car and you're going to finance it, so you have to consider not only the cost of the car, the principal, the interest, and the opportunity cost. So we discussed this a little bit in the last part, but I just want to reiterate it. All right, so here's the $30,000 financed at 5% over 60 months. Your car payments, $566, as we determined earlier. The total amount paid, $33,968. So $39,668 was interest, but what about the opportunity cost had you paid cash? So let's look at the 5%. And let's calculate that over 5 years. If you calculated all the costs involved, in this example is $5,054. But what about over your lifetime? So depending on where you are in life, how old you are, If you're older, you might only have 10, 15 years left of driving, 5 years. If you're younger, you may have 45, 50 years left of driving and buying vehicles. So ask yourself, every time you buy a car, would you rather transfer this money away or keep it in a system that you own and control? Because as you see, this number can get pretty large over time. So we all have a need for finance. In the book, Becoming Your Own Banker, Nelson used a car, an automobile, because we all like to drive cars, and we're going to buy new cars or even used cars over our lifetime. He also used a simple explanation of a grocery store in the book. If you've ever been a business owner or you aspire to own a business, this might relate to you a little easier. The main thing that you need to understand is that we finance everything that we buy. So why not store our capital in an account that we own and control and utilize it for financing? It's our collateral that we can borrow against to make major capital purchases. So as you can see, financing over your lifetime can be very costly. The good news is when you finance through your own system, your own private banking system that you can create using the infinite banking concept, you can recover some of that money. And the difference will literally be millions of dollars over the average family's lifetime. If you'd like to learn about some of the other ways that you can finance using dividend-paying whole life insurance and the infinite banking concept, you might want to check out some of my other videos where you can learn about financing expenses, financing retirement, or whatever you might be trying to solve for. But we want to solve for finance. So I hope you gained some insight from this video. If you liked it, please give me a thumbs up and smash that subscribe button. And I'll see you in the next video.